Today we are analyzing Fortinet Inc., ticker FTNT. Over the next few minutes, I'll discuss my thoughts on both the valuation of this company and its business quality. First up, we have a market cap of $46 billion, enterprise value of $45 billion. So you can see some net cash on the balance sheet of about $1 billion. That's always a positive sign to me that they're not having to use debt to leverage up their business, operating in the software industry, which tends to be a pretty good high returning industry. Fortinet provides broad, integrated, and automated cybersecurity solutions. Cybersecurity, of course, being a really good growing industry. Of course, America, Europe, basically all around the world, has hardware, software licenses, various security and networking functions, firewall, prevention, malware, virtual private networks. They also have a FortiSwitch product family that has secure switching solutions. They have networking solutions, hardware appliances, everything along those lines. So it's security solutions business in the software industry. So this seems like both a secular growth industry and software tends to have high returns on capital. All very positive signs there. Now, first thing we can see here is that they don't have 20-year history, which means that they probably relatively new as a business. 2006, there's no data here. So we're assuming kind of like startup period these first few years. They had a loss in 2008, but they made a lot of money in 2007, 2009. It looks like they have been profitable every year since 2009, which to me is a good sign. I'm not worried about this loss in 2008. One, that was a recessionary year, and two, this looks like it was kind of like a startup phase for them as a business. Now, the returns on invested capital trended down to about 4% in 2017. They got down to as low as 1% in 2015, but you've been improving steadily since then. In fact, the numbers have been very impressive since 2018, where you've posted a 41%, 28%, 44, 45, and 68% return on invested capital. These are just incredible numbers, especially because we would assume that their capital invested has gone up over time. We can kind of see, kind of like starting up expenses, kind of getting in, leveraging, trying to really invest in that growth. And now you're really seeing these returns become just absolutely incredible. When you start talking about 68% returns on invested capital, I mean, anything above 20% is amazing. But these are accelerating returns. So I really love what I'm seeing there in terms of the potential for a business, because it means you can self-fund absolutely all of your growth. You're not going to need debt. You're not going to need dilution in order to do that. Of course, we already saw that they have net cash. We're going to do a deeper dive, of course, on the balance sheet later to take a look at that as well. One of the things that you like about companies that self-fund is the return on equity and return on invested capital tend to match up, 18.1, 18.1%. So that's always a good sign that you're able to hit these marks without the debt. That's a key issue to really get towards the top of my watch list, is when you can self-fund your growth, and we can see that they're able to do that here. Return on invested capital, of course, I usually want a 10% return here. Return on equity, I usually want 15%. Both of these easily hit those marks. One thing that's really interesting, you have these high gross profit margins, which are common for software companies, 70 to 80%. Very good numbers there. Now, the free cash flow is at 31%, EBIT's at 12%. I'm going to assume this gap could be in part due to some share-based compensation. We're going to dive deeper into that when we get to the cash flow statement. But ideally, you'd have these numbers a little bit closer. I don't really like that there's a big gap between EBIT and free cash flow margin, but either way, those are pretty good numbers. Now, these 10-year growth rates are amazing. There's really no other way to put it. Growing your revenue at 23% and your assets at 20% means that you're growing your revenue 3% faster than your assets. That's going to give you some operating leverage in terms of your returns on invested capital improving over time. And that is what we see, is that your returns of capital are getting better and better. Likewise, it's going to give you some leverage on your EPS balance sheet. Or your EPS. So your EPS is growing even faster than your revenue, up at 30% a year. Anytime you're growing at 30% a year in terms of your profitability, that's simply amazing. When we go down to this trend of earnings, you can see what that looks like. You earned 5 cents in 2013, and you're earning $1 10 years later. So you're up 21 times higher in your earnings over a 10-year period. It's simply amazing. If you could repeat that again, it would be an incredible investment to be invested in this company. Now, of course, when you're growing this fast, it gets the attention of the market. Growing at 20 to 30% rates of return is very, very good, especially when your recent returns on invested capital are higher than your growth rates and you're self-funding it all. It becomes the potential for an outstanding home run investment. What that does, though, is it gets the market aware of it. And so everything here is saying, hey, this is an incredible, high quality company. However, when the market's aware of it, they bid it up. And so you see this PE of 54. We can see price, $60.58, dollar earnings per share in 2020. So you're in that 50 to 60 range in terms of your PE. So it's just very highly priced. The other way to know it's highly priced is when you look at price to sales of 10.5. I never buy companies that have a price to sales ratio higher than 10, because the price to sales ratio higher than 10 means that basically you can't achieve a 10% return on your current earnings even if you have zero expenses, because that's just an incredible amount of price to sales ratio. You'd have to take out all your expenses even to have a 10% earnings yield. You're not able to do that. It's why you're basically just matching up to these are very high rates at which the company's growing. The market recognizes it, but you also have an incredibly high valuation. That doesn't prevent it from going on my watch list. It does prevent it necessarily from being an immediate buy, because I just would want a cheaper price than what I'm seeing here. Now, you can justify those sort of prices when you're growing like this. If we imagine 10 years in the future that we have grown earnings 20x again, well, now we're saying that you're trading at 3 times earnings 10 years from now. Well, you're still going to get a really good return there. That means you could 5x your stock price over the course of a decade. That's going to give you market-beating returns. So it's not that it's impossible to achieve market-beating returns based upon these prices. It just means that you're dependent on ongoing high growth rates, ongoing returns on invested capital in order to do that. Is it possible? Yes. But you're going to have to do an extra analysis on, overall market size and things like that. The easier way from a value investing perspective is to get a little bit of a cheaper price. And so that's where, I'm tending towards this being a watch list stock. The next thing I want to look at, though, is when I look at revenue growth across the decade. We're talking about 20% plus revenue growth, but really the metric I want to hit is double digits. And what we can see here is they're hitting double digits each and every year. In fact, the lowest growth rate is 15.3%, which they had in 2013, the second lowest being 17% in 2017. For the most part, they have many years above 20%. They have some years above 30%, and every year is at least 15%. Very good on the revenue growth rate. Now, their earnings per share growth is a lot more volatile, but you have some really good breakout years as that operating leverage breaks in. You can see these big jumps in operating profit as you hit certain, touch points on your revenue. And so that's a really good sign, and I like seeing that. One thing I note here is we want to compare these 10-year median returns of return on equity and return on invested capital of 18% to the recent returns. You can see it breaking out in 2018, and that makes a huge difference, because what you're doing to get this 18% number is you're averaging in these years when they were really getting started and before they hit their operating leverage into the recent years, which are just amazing. And so maybe they weren't able to self-fund their growth during this period, but certainly over the last 5 years and probably going forward, they're likely able to self-fund that growth now that they have skyrocketed ahead of their overall asset cost and startup expenses. So good sign there in terms of everything I'm seeing so far. If you're enjoying this video, hit that like button. And please consider subscribing. But before you do, I'm going to convince you to do so with the great content and value I'm adding over the next few minutes. So, income statement. You can see that their gross profit has grown like gangbusters. They're up 8x on their gross profit over the course of a decade. The only downside, of course, is that they're also up 8x in their SG&A. And so that's a limited amounts of operating leverage on that line, but they've not grown their research and development as much. And so that's really where you're starting to see some of this operating leverage, because you've only had to grow your research and development 5x, which is allowing more of the gross profit to hit the operating profit line. And because you're not using debt, you're able to actually have that money flow to the bottom line. And it looks really, really good from that perspective. Now, again, talk about these 5-year periods, 2013 to 2018 and then 2018 to 2023 is a good way to think about it, because what we can see is for the 5-year period up to 2018, you were diluting the business. The business was getting more and more dilutive over time. You started with 840 million shares outstanding. You ended at 891. So you added 5% more shares over the course of that 5-year period. But then the next 5-year period, once you're able to self-fund the business, they've been able to buy back shares, and you can see that the shares outstanding has declined about 10% over the next 5 years. And so that's the switch that has flipped. Once they started making a really good profit, now they've been able to buy back shares. Now the business is self-funding. It all looks really, really incredible going forward. I mean, the best time to buy would have been right before this switch, and you would have gotten that big jump in performance. Now, if we go to the balance sheet, it's important to look here at PP&E. You can see that they've been investing back into the business, right? So you did go from 26 million in PP&E to 900 million in PP&E. But of course, you're earning 100% returns on that capital. I mean, you're basically at 900 million in net income. So there's no reason to not just keep investing in this business because it's going very, very well. The reason your return on invested capital is lower than that, though, is because you have stuff like cash on the balance sheet, short-term investments, accounts receivable. You have very little inventory. So, I mean, just taking that inventory plus PP&E, there's almost no goodwill and intangibles. So you can just see the high, incredible returns for reinvesting in the business. You want to keep doing that because it's giving you very strong returns, and there's no issue there. They've been able to offset that with a little bit of long-term debt, which I'm totally okay with, offsetting that PP&E with your long-term debt. Seems like, especially at cheap, interest rates, that would have been a good idea to kind of get and even boost your returns just a little bit better, especially because you're holding the cash on the balance sheet anyway. One of the things that's really interesting here is you see the retained earnings has flipped negative, and that's going to probably be seen based on our buybacks, is where they're basically able to fund the entirety of the business without shareholders' equity. This is something you only see in the highest of quality companies or incredibly risky companies, but I think this is more on the highest quality of companies. They've been able to increase their buybacks so much that they've been able to turn the business into a negative shareholders' equity and fund it completely with the debt and so the liabilities. And so that's a really strong sign in the trust in the future quality of the business. And I was right about the stock-based compensation. You can see very large stock-based compensation now, $200 million a year in stock-based compensation, began at $44 million a year. And what you see is those first 4 or 5 years, your stock-based compensation is outstripping your buybacks. But since then, buybacks have been able to completely outstrip the stock-based compensation and start reducing the share count. So that's a good sign. Very little amount of cash going into PP&E, strong cash flow from operations, very little depreciation. So the biggest negative is just I don't like companies with stock-based compensation, but this is par for the course in the software industry, so it should be expected. As long as the company continues to dump all of their excess cash into stock buybacks, I really like that use of cash flow. And so it's overriding the stock-based compensation, and I'm totally fine with that arrangement. So Fortinet looks very, very interesting, and to me is going to be added to my watch list. This is an incredibly high-quality company. Anytime you see this skyrocketing effect off the return on invested capital being hugging towards zero and getting into the 20, 30, 40, 50, 60% range, you start to become very attracted in the underlying returns of this business. It looks like they've already hit their operating leverage point where they're starting to skyrocket up. Their EPS is growing faster than revenue. They're self-funding all this growth. They don't need debt to do it. They can actually fund the entirety of the business without shareholders' equity, which means that they can be really leveraged to, this is kind of like a PE style of running your business, and they're really set up for strong future returns on the business level. Now, as an actual shareholder of the business, your price that you pay does matter, and so for that reason, I'm not necessarily buying today, but it's definitely going on my watch list because if I could get a cheaper price, this is exactly the type of company with this sort of growth that could set you up for very strong returns in the future. So for that reason, Fortinet is going on my watch list. I hope you've enjoyed this video. Please like this video. It helps let YouTube know that you're enjoying my content. Don't forget to subscribe. I'm putting up 3 new videos each and every week. We're working through the entire S&P 500. And the playlist at the top is my watch list stocks, which are my favorite companies in the S&P. If you like this one, you're going to like those as well. So please check those out too. And if you're wondering about this software that I'm using, it is quickfs.net. My affiliate link is in the description below. Please consider using my affiliate link. That's a great way to support the channel. Doesn't cost you anything extra. You can still get a free or a paid account through that link. And it's just a good way to support the channel. Let them know that I sent you. Thank you for listening. And until next time, stop paying fees, start building wealth.